or in his company. I gave my best friend my job. He is now worth $60 million and retired, and I'm still working. So I might not be the smartest guy in the room there. But I've been with loanDepot for about a year and a half. We've grown quite a bit. loanDepot as a company, I think, does a fantastic job. One of our best strengths is getting loans through the system. I'll just tell you, I don't do a lot of loans. The last 2 loans that I've done, I've had cleared to close, both of them in 15 days or less, and closed them. Because that's the one way I negotiate with my buyers, is saying, hey, inventory is sitting on the market right now. Why don't you offer a quicker close to the client or the seller? Because most of them right now, they're in a panic because their homes aren't selling as quick. One guy, I'll just tell you, the home was listed for 1.35 million. We offered 1.25 because it was sitting on the market for 300 days. He ended up getting it for 1.27 and it appraised for 1.45 because we were able to offer that quick close, and the lady was just in an all-out panic. So that's one of the strategies that I use a lot of times. I brought 2 of your other loan officers that are assigned to you guys, both bilingual, and they're both technically superior at their jobs. So before I get going, Andres, if you want to.
I'm Andres Rico. A little bit about me. I've been in the mortgage business for about 9 years now. I am from a small town called Douglas, Arizona. It's a border town. Family's from Agua Prieta, Sonora. I would say 75% of my clients are Hispanics. Obviously a little different clientele. One thing I do make it a point is to meet all my clients face to face. I know questions come up, and it's just a little bit better for conversion on both of our ends, right? I do see a lot of people who speak Spanish too, so it's my first language. If you guys have any questions too.
¿Español es tu primer lengua?
Es mi primer idioma, así es. Poco de mí es que te diré, vivo ahorita en Tucson, Arizona, pero me la llevo aquí en Phoenix. Tenemos muchos programas. I would say a lot of our two core values I want to point out from our team is proactive communication, right? As far as a lot of concerns that I get from other agents are communication. As far as agent updates, once we're under contract, you're going to be updated every step of the way. I have a really good team behind me that's going to be able to update you for every step once we talk to that client too. Another one of our core values I'd like to stand out too is never say no without a solution, right? If you go to a larger bank, there's going to say, yes, you're approved, no, you're not. There's always going to be an action plan, or this is what you got to do to get approved. We're always going to have a solution there. I've also worked for some of the top teams in the country, top producer as well. I've seen a lot of loans. So if you guys do come across any scenario that you think that loan can be there, give me a call. I'm pretty sure I can answer your question pretty fast. And if it's a little tricky, I will get back to you pretty soon too. So.
Can you give loans to people with credit score like on the 530s, 540s?
Yes, we can with 10% down depending on the approval, minimum.
Standard FHA rules on that.
And then conventional used to be minimum 620, but they actually went away. So if they get a pretty significant down payment, I've gotten the approval as well. So manual underwrites, a lot of people too, if you guys have any turndowns, we do accept those. We've gotten a lot of loans done that people can't. Manual underwrites, not sure if you guys are familiar with those. So basically the way the loan works is we have credit, income, assets. We submit a file into what's called underwriting AUS, automated underwriting system. Basically that tells us whether if it likes the loan or it doesn't. But for FHA, there's also ways around it where we can get them approved through a manual underwrite that a lot of people don't know. So when someone tells you no, you definitely want to ask them if they're eligible for a manual underwrite too. So I'm pretty sure we'll get to know each other a little more. I'm happy to do any lunch and learns for more specific products. And again, any questions you guys have, I'm a phone call away.
How long before you moved to Phoenix, Arizona instead of Tucson?
So I'm back and forth. I lived here in Phoenix 4 years. I moved back like 3 years ago, but I'm back and forth. Plan is to be here a little more often too. I'm super familiar with the area. My old office was here off Litchfield and McDowell. So I'm pretty familiar with the area too.
You have manual underwriters, right?
Correct.
So the manual underwrites, not every company does it as well. We're going to look at, hey, we're going to follow the guides if we can do it. Even if the underwriter originally will tell me no, then I get in there and push it further and say, hey, we should be able to do this. I go to the head underwriter of the whole company, and I would say probably about 70% I've gotten the no to a yes on there. Because we follow the guidelines. And if you follow the guidelines and they get it, it should work, no matter what. And we'll do the manual underwrites to the higher DTIs too. We follow all the guides, so. On approve eligible, that's the AUS we're talking about. On FHA, it's 40 or 56.99. So if that Dutch ratio is there, it's approved automatically, no questions asked. Monica, you guys, some of you met Monica last time we had a lunch.
Yeah, my name is Monica. I work at the Uptown Phoenix branch with Eric, so that's the branch that we're both based out of. So we kind of go all over the valley, obviously, so we're here in Goodyear. I'm also bilingual, speak Spanish, so I work with a lot of Spanish-speaking buyers, and the number one compliment or feedback that I get from them after every close is, you were so patient with us. Which we know Hispanic borrowers require a lot of hand-holding, a lot of in-person meetings, a lot of collecting documents in person and whatnot. So I know the drill. I've worked with some that it took a year to qualify them, a year to get them there, and then they finally closed on that home. And so that is a good feeling, you know, when you see like where they started and how happy they are when they finally get that home.
When you tell them what they need to do you follow up on them and like call them, oh, how's it going, are you always?
Yeah, I put together a plan for them. Yes, I check on the progress. You know, obviously the agents are usually very involved as well. Sometimes they need that extra push to get them there. And then also just like helping them learn some of the online stuff and how to send emails and things like that, just because it speeds up the process for everyone.
Like creating emails for some of them?
Yeah.
Yeah.
We're not
Been there,
supposed
been
to do
there.
that, but yes.
In there.
Yeah, no, and then, you know, I'm happy to like sit with them and translate things for them and go through everything with them until they feel comfortable, and then even just like teach them like, okay, so this is how you e-sign. And I've gotten like on FaceTime calls and had them share screen and be like, okay, now click this button. It took them a long time to find the button on their own. But yeah, it's a really rewarding experience when, you know, the whole family is thankful and whatnot.
I'll give you an example for her. I do loans, but not a lot of loans, so I don't have a lot of time. So I gave her a for sale by owner VA deal. Client had no knowledge. The seller, she's a little bit, it's his sister for part of the state. She was a little bit more knowledgeable, but it's still, I kind of gave her a little bit of a hot mess. And she had it closed, I think, in about 15 or 20 days on a VA from start to finish, and was able to give the client $20,000 cash back, structured it through there because they had to pay off 3 siblings at $50,000 each, and then he had to pay some debts to qualify. So she set it up with his sister so that the sister would give her the cash after the close. So everyone won, and the client couldn't have been happier. So it's about the loan officer. Not always about the company, it's the loan officer who can put it together and have the patience. So I'll say that. Condo changes, it's getting harder. It's not gonna be as easy. I don't know what's gonna happen to values of condos because buying them is gonna become a little bit more difficult. But that's still part of our market. We have to be able to do condo sales. What does that create an opportunity for? I think for the agents here, some people need to become condo specialists. Create your own niche, get familiar with the rules. If you're doing a listing on there, the more knowledge you have, probably the better chance of getting that listing. If you have a buyer that wants to buy a condo, asking the right questions up front will give you a more successful transaction. And what we want to be for you guys is pretty much just a resource. If you have a listing that's coming up, let's talk about it. Call Monica, call Andres. We'll try to get you all the information. Is it already approved by conventional? FHA, I think most people here know how to do a condo lookup on FHA, correct? Or if not, I'll send everyone the links to do it. There's also a VA you can look up to see if those are approved. when we go through the condo changes on Fannie Freddie, what happened is Fannie Mae and Freddie Mac got together and said, hey, we need to change the rules collectively. So that's where it's getting more difficult on there. So, does everyone understand the difference between Fannie Mae and Freddie Mac at all?
So that's conventional, just FYI. Conventional
They're
rules.
both conventional, they're both kind of quasi-government agencies that make the rules. Fannie Mae's rules are a little bit different than Freddie Mac's rules. Sometimes the pricing is a little bit better with Fannie Mae, sometimes the pricing is a little bit better with Freddie Mac. We sell to both of them equally, and we want to make sure we always take advantage of the more generous rules. Sometimes we'll get an appraisal waiver on Freddie Mac and not on Fannie Mae. So in our system, it runs dual, both systems automatically as soon as we press that, so we're gonna take the more favorable results. When it comes to self-employed people also, Fannie and Freddie have different rules. Freddie is a lot more generous on some of the rules, so we'll look for self-employed people a lot of times through Freddie Mac, so. Didn't plan on talking about that, but just for your knowledge, it helps out to understand what we do. So, unfortunately, some of these have already went into effect, so I'll just kind of hit some of the highlights. This is a positive thing on there. Expanded the projects up to 10 for waiver of review. So some of the smaller complexes will get approved much easier on there. This doesn't really come to you, but I'll ask this question. Why do you think it's getting more difficult for condos? Anyone have any ideas?
Investors?
What?
Investors?
It's investors, but why are they making it more difficult?
The reserves. It's about the reserves.
It's reserves, really it's because some are running into financial difficulties. Florida, we saw the collapse of some of the condos. Different condos are getting older now and they need some work on there. Whether it's they have water leaks or litigation on it. There's more risk to condos than there are single family homes. And they finally got together and said, hey, we don't want to take all the risk, we're gonna pass some of the risk back, or do additional scrutiny on the condo complexes to make sure that it's the right investment and it's properly gonna succeed in the future. So, but a lot of it came from the Florida problems that they're having with condos. Investor concentration, this is a good thing. They went to 50% investor concentration no longer is there. That used to be a big thing on condos. Hey, if there's more than 50% rentals in there, can't be done. At least through Fannie Freddie. Also, FHA, that's a rule that they would look at too. So this is in our favor because a lot of people want to buy the investments and they don't want to let them go because they're cash flowing very well. So sometimes those are performing better than a first or second home on there. Master insurance policy, this is one of the big ones. They want the insurances to have better coverage in the event of a catastrophe of sorts. So the insurance that the condo HOA has to pay is going up because they're requiring the condo deductibles coming down on there, and they want to make sure in the event if something happens, their insurance is gonna cover it correctly. Limited review, this is a Fannie Freddie thing. Used to be, if someone would put 10% down, we'd run it through the AUS systems, and the AUS would say, this qualifies for limited review. The big thing is, this would be gone on a limited review, certain things would get streamlined on a limited review. Therefore, if we couldn't get it approved at 5% down, we'd go to 10% down and it would approve it, life is much better. That's went away. So that option has went away. Reserve study, you guys had mentioned this, that's the big thing on there. What is a reserve on HOA? 10%. So if it's a big complex, that 10% could be a really large figure, right? It just doubled. So it went to 15%, so not double, but went up 50% on there. So what will that cause? Anyone have any ideas? Higher HOA.
People can't afford it.
People can't afford it. They became riskier there, and what else? You're gonna have maybe some capital contributions to get caught up. So, hey, you know what, we're down, whatever, and there's only 50 condos in this complex, and we're down 500,000, whatever, some low figure. Well, divide that by them, hey, you're gonna have to do a catch-up contribution for us.
100 for 5 years or something,
Yeah.
$100 extra.
Not a fun thing to happen. I have a couple of condos that I own also, and mine just went up on one in Tempe. And it's like a $2,000 catch-up contribution. So, not, a lot of people, that's gonna change their lives. Hey, I don't have $2,000 to do this with. So, that is gonna be different. Master policy, per unit, required perils is now 50,000 per unit. So that's gonna be more expensive, but then the homeowner's own policy has to match that $50,000 also too. So the individual policies might become a little bit more expensive too. But it's all to ensure the rest of the people in the condo, because if you have people failing, they're not putting their contributions in, so they're making the rules for everyone on there. And then this is the big one that we've talked about the most. Replacement reserves minimum of goes from 10 to 15%, that starts in January. So everything else that you guys are running at, this is the biggest thing, I think. That, limited reviews, and the insurance. Those are the three things that you guys need to talk about with the clients. So, how many here do a lot of condos or? Well, you seem very happy about that.
I've had problems with it to begin with, because they didn't have the reserves, and it's,
And guess what? I've called many times to the HOA and say, hey, you're at 8%, I need you to get to 10%, and they kind of laugh at you. Sorry, there's not a lot we can do.
Yeah, I had one, and they had, the way they did their sheet to give to the lender was all off, so the lender had to kind of communicate, and also me communicate, hey, adjust the way you write it so it shows correctly for the lender, so they had to do that. They did that for, this house. I don't know if they did it for everybody. It looked like they did change the way they were gonna write it up, but it was the 10%, they had 10%, the way it was written, and then there was something else, but anyway, so yeah, but it went through, but.
How many people have called the HOAs and tried to negotiate things? How does it usually go?
No.
Yep.
if you get in touch with them.
It is not a great thing, so. What options do you have in case we couldn't go? Conventional. FHA, you guys have looked it up. If FHA, the condo is not FHA approved, what is your next option there? No, there's actually, what?
Conventional.
No, there is an option.
Yeah,
Spot
so
approval.
We did that, this one wasn't FHA approved, but they did like a one-off, I forgot.
Yeah.
what it was.
Spot approval is called, yeah.
You wanna explain that?
Yeah, spot approval is so it's called a spot approval. Basically, if you bring up the condo list for FHA, there's very few condos that are already approved. I've done a handful of them, and the thing is, it's not always guaranteed. So we got to get the condo questionnaire, the condo documents, send it directly to HUD, and basically they're going to say it's approved or not. But I've probably done 5 of them, and I've gotten all 5 done, to be honest. So
I'll tell you-
it's just not guaranteed. Is kind of like the thing we need to know.
Have you done spot approvals yet?
No, the
Oh.
condos I've done are conventional.
So I'll tell you this, I'm probably 80 to 85% getting the spot approvals done too. Now, you can probably look at the spot approval when you get the HOA sheet, condo questionnaire filled out, you probably know if it's gonna get approved or not, so.
What if we're being told that there's no more spot approvals that are gonna be done in this community? Is that?
I haven't had that occur, so I can't tell you what it is.
I've got a condo from hell.
Call me after this and I will follow up with you on that question.
It should be for the whole community though. It should be for the whole project, not like individually. They're saying there's no more for the community?
Yeah, the last one they got through was just a few weeks ago, and they were just doing FHA because they could do the spot approvals on. And the last one they got through, I talked to the listing agent, they said absolutely no more spot approvals.
So,
For that community?
So call, we'll be happy to do a little research for you.
You mean like there's a limit per community of the
That's-
spots?
There is a sort of limit on there, they don't want that many more on them, but
Yeah.
that could be, hey, we shut it down for a month, it could be whatever, so we'll be more than happy to
That's what I
call.
wanna know. Thank you.
What are the three that you said that we should focus on?
Really, the three are, limited reviews are gone, the insurance, and then the reserves. Those are the biggest things. And we'll go, the next thing we'll do, we'll talk about it a little bit more too. But I'll go with this,
Thank you.
assuming Fannie won't do it, assuming Freddie won't do it, and there is a VA list, if no one has it, I'm sending them to Martha to make sure you guys have all those tools, that you can look them up yourself. The other way to get those answers is call one of these two.
Yeah, once you come across that scenario, we'll work through it together too, for sure.
Yeah, just call them. Fannie Mae, Fannie has a list too. I can get that information. I had to request it yesterday because I didn't have it. These guys can't get that Fannie Freddie list. It's something that's only supposed to be for loan officers. So what I will tell you is you guys, you can call and ask through, if it's Fannie Freddie through them, they'll get through me, or call me directly and we'll try to get that answer for you right away, because it's a simple lookup.
What he means by that is agents or the public won't have access to that list, but if the lenders will.
To get a spot approval, what is it that you required from the agent?
It's just a simple condo questionnaire. So we get the.
It's
we
from the
have to-
HOA,
Yeah,
correct?
we have to pay for the questionnaire from the condo association. I don't know, the last couple of ones, are they $300, $400?
Yeah, probably a few $100s, yeah.
So-
They determine the fees, so there's not like a set fee.
Yeah. And then we send it in, it's not instantaneous, it usually takes 2 to 3 weeks, sometimes more. They always quote more, but we usually get them done quicker than that. So part of it is, there's a little bit of a mystery period out there, on there. It's not the greatest system in the world, but it still helps getting them through. As you've done it before, it's not the most fun.
Well, and I'm working with the HOA right now, I actually have a call back into, because they needed to submit their paperwork, in which he said they've done it, he says, we don't know how long it's gonna take to get that back, so that's what we're waiting to see if, they're trying to get their approval.
I think a lot of times it can be, it might be the lender's relationship with Bud and Fannie Mae, the hawk, but it's, in my thing, we've seen most of the times 2 to 3 weeks on there.
Latest, for sure.
How is your relationship with the?
The loanDepot, I will say, is really good because we're one of the larger lenders out there.
Yeah.
VA, we haven't even talked about VA much, but we're one of 3 preferred lenders for VA in the country. In fact, having a big presentation on, we're having our VA team come out to do some of the VA loans. VA loans, one of the reasons why we are preferred as a lender is because we will do those manual underwrites where others do not do them the same way. We have the whole VA lending team nationwide, and the 2 guys are coming out to do a presentation on it. But I see that we do a lot more VA deeper than other people will do. So,
One other thing I heard was portfolio loans.
Yes,
Yeah, that's-
non-QM, so
you
that's
wanna
what,
talk about that?
yeah, that's
You guys?
also
How do you spell the first one? Was it?
which one? Which,
Spot approval?
oh, the spot, yeah, that spot.
Just like spot removal.
So non-QMs, in other words, the portfolio loans, they're actually one of my favorites because I'm pretty familiar with them. There's a lot of loans, right? But like, at least the most common ones are basically the bank statement loans, right? I'm pretty sure most of you guys are 1099, so you guys kind of know how taxes are filed. When a client files taxes and they're not preparing to buy a house, the CPA's job is to save them as much money as possible, right? Say they make $100,000, they write off $80,000 just to not pay Uncle Sam, and we can't go based off the gross if you were W-2, but we got to go based off the 20,000. That limits us how much we're able to qualify them. But also the solution there, instead of waiting the other year till they file, we can collect 12 months taxes from them. We do an average of, what's that?
12-month bank.
Correct. 12 months bank statements from them. We do an average of their deposits, and we completely avoid the taxes. So I've seen people who probably went from like $4,000 a month in income to $30,000 a month in income, right?
Those are portfolio.
Their portfolio. The minimum down payment there is 10% depending on credit. depending on credit, but pricing is not that far off, to be honest with you, depending on that.
Is there a reason why some banks will only take so much of that bank statement, and like what are they looking at? Because if, for me, example, one was like here and one was like,
That's a really good question you're asking there. So basically, the standard guideline is that, say they do the deposits, the standard deduction there is that you do 50% expense ratio, right? So 50% of their expenses get deducted from their income. So say if we get $50,000 in total income, we go 50% and their income is $25,000. Say they want to qualify for more, we can get a CPA letter stating that to keep this business running, their expense ratio is 20%. So if we get that letter, now we can increase it to 80%, and now it increases their monthly income at that point too. So there's different ways to get creative with those. That's why they're one of my favorites, because a lot of people don't really know how to do them. So that's a really popular one. And also my other favorite one is probably the DSCR. Are you guys familiar with the DSCR? Basically, it's for investors. You do need to own a primary residence to qualify for the DSCR. Basically, no pay stubs, no taxes, no income. As long as you have anywhere from 15 to 20% down with decent credit, we're gonna order what's called an appraisal and also a 1007 appraisal. That's gonna determine what the market rents are in the area. As long as the market rents covers the mortgage payment, you qualify. And I've actually just closed on one. I gave them a 6.25 rate on that. You're also able to add what's called a prepayment penalty that you're not able to do on conventional loans. Are you guys familiar with those? So prepayment penalties, you can add anywhere from 1 to 5 years. And basically, 5 year giving you the best terms, as you can see. It's lower than primary residence right now for conventional. The bank likes to see you keep your mortgage for a little longer. So if you're gonna do the 5 year, you're probably planning on keeping that property a little longer. And the way it works is that if you pay off your house within the first year, you're gonna pay 5% of that balance. The second year, you're gonna pay 4%, third year, 3%, and just declines at that point. Say if rates were to magically go down to 3% again in the next 3 years, maybe it benefits you to refinance, right? You just pay back the 2%. Say you have a loan balance of $300,000, you pay $6,000 for 3%, why not, right? You're not stuck to that term for the 5 years, but if it really makes sense, we'll do it.
So what I'll tell most of the guys, and Monica, is talk to your client about the prepayment penalty. You can get better terms at a cost. So try to match the term up. A lot of times I do 1 year prepayment penalties. Why? Hey, the rate's already pretty good. You can hold on to this for a year, and if rates get better, then you can refinance. But it could be a 2 year or 3 year terms. The 5 year one can get pretty punitive. If something happens, you have to pay a 5% prepayment penalty.
Yeah.
On there. So it's just a discussion with the client. They choose what fits their needs.
Mm-hmm. And we'll have that discussion. And I love when agents are more involved too throughout this process, because, like I said, I really pride myself in communication. So every step of the way, I'll tell you where we're at with this client, and little nuances that you guys might know, and now your next client, you're going to keep having in your back pocket and be able to answer at least the basic questions that you might not have been able to answer at that point too. So, like you'll learn a little bit, at least what the basics are for lending as we go too, on the clients.
So for realtors, and I know we're straying off topic, but a lot of truckers, different things like that, there's 1099 programs too. So I know one of my realtors, I'm looking at helping him buy a house, and he was looking at, do I file my taxes? I brought in $275,000 last year, and file them because I'm going to need to show at least $130,000 of income on there, or do I do a 1099 program? 1099, you take 90% of what you made on a 1099, and that few small other rules. You have to have some reserves, but that interest rate was like a quarter point higher than the conventional was. Well, I'd take the quarter point higher and not pay an extra, $70,000 in taxes.
And piggybacking on that, we just said, so yes, the down payment requirements are a little higher for the non-QMs, but this is the way I like to present it to my clients, right? Would you rather give $50,000 down as a down payment for your house, or would you rather pay the IRS $50,000 and pay buy your taxes more income, right? At the end of the day, it's like a no-brainer at that point too.
Well, so, sometimes what happens, people think that the down payment is money that they're losing, that they're just paying out. And I always say, no, it's going directly towards the amount of the purchase of your home.
Yep, and no mortgage insurance, even 15% down, 10% down, no mortgage insurance at all for those type of loans either.
I don't know if it's, not, to ask you, but what is an average cost for closing cost with your company?
Typically, I mean, the only fee that we charge is $1,600, right? That's the only fee that we charge, right? Appraisal, others are third-party fees, the appraisal, the property tax insurance that we collect up front is just the title company. So depending on the loan amount, say 400,000 probably adds up to like $8,000, I would say. But I also give the option for sellers. I give all the buyers the option to pick their own rate. Bring up the rate sheet. Look, you can get as low as a 3.99 all the way up to 8%. You get to pick. But I show them that 3% might cost you $50,000 up front. It might not make sense for, even if we had that money, it might not make sense. Assuming rates go down, once they do, we're gonna refinance your loan at no cost to you at that point. And actually, a lot of my past clients took advantage of that. There was a good dip last year where people I financed 3 years ago where they had a 7.5, I got them a probably like a 5.99, saved them $300 on their monthly payment. So obviously no one has a crystal ball what the market's gonna do, but we're gonna refinance their loan at no cost to them once it benefits them to do so.
So that was my next question. A refi, I have a couple of customers. I keep track of my customers that have higher than 7% interest rate.
Mm-hmm.
Because when I hear that someone can get them lower, not just 1 point, because it has to make sense, because I guess what I hear refis are costing 8,000 to 10,000.
That's it. That's the thing, right? And unfortunately, a lot of lenders aren't transparent with that. When you see those high fees, it's because they're advertising that very low rate. If you go on QuickenLoans.com, take an example. Go on Quicken Loans, you're probably going to see a 6.25. What they're not going to show you, you're going to click on the little arrow where it says disclaimer. In small print, they're going to tell you that's 6.25. Assuming you have a 780 credit score, you give 20% down. Also assuming you pay 2 points. So when you say a low rate, that's 2 points on top of that $8,000 in closing costs. So it really just depends on what rate you want at that point. And we're super transparent when it comes to pricing, so let the client choose at that point too.
And that's where you have, it's all about honesty. I hate to say, you have to say, because I have some lady of mine that closed at 7.375. She's begging to get out of it. When we looked at it, I'm going to 6.5. Now hers was a $600,000 loan. So did it make sense? I said, at this point, it's a coin flip. Either we wait a little bit longer and hope for rates get a little bit better, or you're comfortable still at that rate. She said, let's do it. So in that case, it's saving her. She skipped a monthly payment. It was worthwhile. Closing costs, I kept to a minimum. I tried to give her a little bit of a credit towards costs. And it cost her about $4,000 to refinance. When she was saving 3/4 of a point on 600,000, she was making that up the first year. So did it make sense for her? Yes. Did she want to get to 6? Yes. It just wasn't.
Yeah, and a lot of borrowers get stuck on the rates, but say if they are stuck on the rate, obviously it depends on the monthly payment, but say, I'm waiting till rates will drop to a 5.5, an example, right? Oh, what if you want a 5.5? That's when we work together. Hey, to get a 5.5, we need 5% seller credits. And that's all they're gonna buy. Well, I can get you a 5.5, but that's when we work together. Let's get 5% seller credits, and then maybe they wanna move forward with that lower rate, right? So there's different ways to structure it. At the end of the day, it's really just trying, the first step is really just building that trust within us, you guys, and the client at that point too.
Are you still able to do ITINs? Are you guys doing ITINs?
I-10s, yeah.
I have
Go on.
Monica answer
I've done
this
a few
because
of them.
I have to tell you something interesting. I went to a reverse mortgage class, and I decided I was going to do a reverse because I owe almost nothing. And so, I was about 75,000 short in what I expected for me to get back on my equity, and it was gonna cost me 14,000 to reverse mortgage. So I said, forget it. But only reason I wanted it is so that I could buy another property with my
equity.
which is like my accountant does, is
The-
I
Yeah.
go as lean as possible, you know?
There might be better ways to get at your equity.
And that might be it might be like a huge point because that you guys are bringing out your closing costs. I didn't know a lot of people didn't know about that. If you guys come across a loan estimate that one of your buyers have, or even one of you guys have, send it over. I'm happy to review it together. There's different key points that we need to see together because you might see just a really beautiful rate, but a lot of cost towards it too. So I'm happy to review it together with you guys.
14,000?
So I'm gonna tell you this on reverse mortgages. We just ran a class yesterday, just so you know. Alex Shelton, who's one of my loan officers, he ran it for the nation on everything on the Home Depot website. Reverses are great for the right person,
Yes,
but they are expensive.
they are.
And you need to know that going in. If you can't show your income, there are some new programs that will allow bank statement HELOCs. Our 5x5 product is an instant issue. They'll look at your bank statements and go, yeah, she makes money, go. We can approve it. So there's more programs out there for HELOCs than used to be. And you got caught in that because reverse mortgage is not the most efficient way to get your equity out of your house.
Correct.
It's designed for different uses.
The hook that brought me in sounded wonderful, but then when I saw the whole picture, I thought, no.
Yeah.
Yeah, unfortunately, there's a lot of low standards in this industry. To be honest with you, it's like it's just transparency up front is the way we roll. To
But
be
yet
honest.
I have seen one person, an old friend of mine that did a reverse mortgage after she lost her husband and she lived in the property for over 20 years. And that was beneficial to her,
There's-
so I thought I'd check it out for me.
There's some really good rules on it, especially, I had a client out in Palm Desert, and it's a bad story because her husband ripped her off and then divorced her. But then she did for her mother, we helped her get a reverse mortgage. Her mother is perfect for it. She bought it for like 200, is when equity was going way up, all of a sudden it's worth 450. She does a reverse mortgage, she lives in it, she has this big equity line that she had too. Mother passes away, or just before mother passes away, before. The client calls me and says, hey, Eric, I think my mother's gonna pass away, we have this equity line of $180,000. I said, well, draw that out immediately. She's like, what do you mean? I go, if she dies, you can't get at that equity. I said, if you draw it out now, you get that free $180,000. It pays you back for what your ex-husband ripped you off on. But she did it and took the money out. Everything's good. Guess what? It wasn't worth that much at all when she finally died. So the bank, whatever you have, if there's no equity left or your negative equity, the bank has to eat. You can just walk away from it on there, or your heirs can walk away from it. I have another one that is there, and I believe, and I don't know this inside and out, but I believe you can buy it for 95 cents on the dollar. Your heirs can, out of the thing at the end. So I just had someone call me yesterday, and I don't know everything about the reverse mortgages. You need to get certified on it. But I called up and I gave it to Alex, and he is taking care of it now. So it can be a great product, but it is definitely not for everyone. And I'll tell you this, probably don't consider until someone gets close to 70 years old. Why? Because at the younger ages, it requires more down payment if it's a purchase or if it's a refi. So that's a rule of thumb that I put out there.
Well, I feel that everybody is getting older, especially I who live in Sun City, I see that. And I wanted to offer that as a product, for myself to increase my clientele. But then.
It's a good talking point for sure.
It's very good. I'll have maybe Alex reach out to you on there because he teaches classes on it. So that's what we really want. All right, sorry,
That's fine.
you've been patient.
That's fine. Yeah, that's fine. I'm gonna go back a couple of dozen questions here. I ran into a situation in Surprise, a condominium complex there, but they were only willing to work with my buyer if he went through one of their lenders, which was Fairway Mortgage. How can we circle around that?
They shouldn't have been able to say that, number one. They can't do that.
Sure was them and not the.
But if it's their best friend and they made an agreement with
They had something.
agent, it's something backdoor that someone did. but
Oh, okay.
you, I mean,
You don't have to.
you don't ever have to.
That's what I.
Was it like a new build condo?
No, I think they said something that there's an entity that owned 30% of the condominium and something because of.
That's where working with the HOA, sometimes you can get past those things. As one person own it, a couple of different people. I've gotten past that in the past. And what it probably is Fairway just got past it. So they're like, you know what,
Yeah.
they already had this fight, they won the fight, work with them.
But
But
you don't have to.
you do not have
You
to.
guys-
Sometimes it's as simple as like switching it from Fannie to Freddie. And not all lenders know that, so that their lender may know that and say like, oh, tell them to work with us, or something like that, but yeah, they aren't legally allowed to tell you, we're only going to approve you if you work with this specific lender.
Yeah, it's kinda crazy.
Unless it is a new build
Yeah, and that, yeah,
Yeah, no, it wasn't.
and
because
even then they
on
can't
the new
say
bids,
only.
you have to work with the builder to get them approved through Fannie Freddie. And Fannie and Freddie have different rules. Freddie, if it's 5 phases, Freddie, and phase one is done, Freddie will allow you to lend on phase one. Fannie says all the phases have to be done before you lend on that. So there's different rules out there. All right, let's go to the next page, and then,
How are you?
it's been a while.
So we're done here?
Yes. So this is kind of talking about the condos again. We might just blow through this if you guys have questions, but I think we kind of might have beat it to death already. If she can turn the page.
That's it right there.
You guys want to go get food again while we turn the page?
Oh, it's not.
It looks like it's stuck.
So I'll add some other questions. We talked about non-warrantable condos. What does a non-warrantable mean? For the most part, Fannie, Freddie, FHA just can't be done. Can you do those with another lender? The answer is yes, through the non-QM products, or we also broker, just so you guys know. If we don't have it in-house, we can broker. Right now, she's doing a broker deal on an I-10, buying what kind of property?
Oh, this is an interesting one. Investment manufactured I-10.
About as hard as you
It was
can get.
very, I had to go through so many to find one that could do it. But yeah, so if you have a manufactured home, I-10, I have a bank that can do it.
For nationals, we do for nationals. Yeah. All of
Manufa- manufactured homes, you guys run into many manufactured homes at all out there?
Yes.
Yeah, I've done it.
Yes? Okay, so we do manufactured homes exceptionally well for, not all lenders do them as well, I think we do them exceptionally well. We'll do single wides on FHA, VA, conventional, not everyone will do single wides.
Yeah, and we also have a product too. I mean, if the client has decent credit and they have 20% down, we can do that loan.
So you did single one?
We do, FHA and conventional.
Do you do them on this land?
We
No.
have a broker that can do
I've
it,
never done
but
one.
I think right now they're only in California.
Can you give me
Actually-
information of the four national that you have?
The for national, very similar to the DSCR one. There's 2 different ways to do that one. Basically, we gather their assets that they have and we combine them to get income from there. But my preference one is kind of just doing, it's a basic DSCR. They don't need a credit score, they don't need a social. Anywhere from 25 to 30% down, works the same way as a DSCR. I've done
No
it.
income,
No income, nothing.
okay.
But also, even if someone that's not foreign national, say someone's a U.S. citizen, they have 20% down, 25, 30, but they don't have absolutely no income we can report. We can do that loan.
Okay.
We can do that loan.
So, do you know why they're called non-QM versus QM? QM is Fannie Freddie VA. QM means qualified mortgage. It means you have the ability to repay. That what was it, 2011 that changed? That's got rid of the stated incomes and all that kind of stuff. You have to prove the ability to repay. Non-QM is non-qualified. That's why we can use bank statements. We can use alternative methods to figure out an income on it. There are some stateds coming back, by the way. I think Change Wholesale.
That's the one I'm talking about, yeah.
Yeah, Change is doing some really crazy things.
And I've done a handful of those too.
So if the person has a want and they have a decent credit score, we can usually find a program for them. Doesn't mean every person is going to be qualified to buy. But if your quiver is this large and you have all those arrows, it's a better chance of getting done. To be honest, I like to stay in this area because then we get the efficiencies. As a lender, we're making all of our own decisions and I go to the same underwriters, the same people and get it done that way. So if it's choice between working in our own programs or brokering, I'm gonna choose every time to work in our own programs. All right, guys, this is just more on the condo changes. Why are condos more scrutinized? And I think we already talked about it, but there's more risk, right? So when you're looking at condos, they're looking at credit, income, assets, and employment for the borrower. It's gonna be a little bit tighter on borrower eligibility on condos. Why? Because the asset's already more risky. Now we wanna make sure that the client is a little bit stronger for the condo. So something that we'll see, we run it through as a condo, we don't get an approval on the automated system. We change it to a single family, hey, they're approved. And it stinks that it is that way, but it is that way because they're looking at overall risk. Lending is all about risk. What's the risk of default on this person? So that in essence is what we're looking at. Now we have to look at the condo itself to see if it's approvable. How's the HOA or financial health? Guess what? There's some that are really, really healthy, and then there's other ones that are hanging on right now. If they're hanging on, less likely to get approved. Insurance coverages, that's been the big one lately too. Master insurance covers, Fannie Freddie sets out the rules, you have to have this much, they're covering their insurance down there. We say, hey, guess what, you have to raise your coverage to get approved. Guess what the HOA kind of tells us? I hate to say it, it's not a very nice term either. But they're like, why should we have to do this? I don't care, we're not gonna sell this one, we'll just sell the next one on there. And we're like, well, you're not gonna really get there, you're eventually gonna have to get that covered. Litigation, what's litigation? I'm sure you've seen it. What happens on a condo sometimes? If one person had an issue, they had a water leak, this, that, it's probably a one-time occurrence, yeah, we can get over it. But let's say it's a health and safety hazard in that whole community. Do you think lenders are gonna lend on it if that's not been covered? I had a condo up in Desert Ridge, I was the only lender on it at the time. They had a huge, when they were building the other additional phases, they plowed the dirt the wrong way. We got a monsoon in, it flooded their entire parking structure basement for like level and a half. Screwed up everything, you could no longer lend there, because now they're going, not only do you have it, and the litigation is pending with probably 50 people that cars got ruined, now we're looking at, you're still building phasing, there's additional risk of flooding down there. So, that can be something. Deferred maintenance and structural integrity, that's the Florida situation. It's been sitting there forever, salt water, the wind, everything else, weakened things, they got the right storm in, and it collapsed. So, condo complexes are getting more difficult. Timeline. We went over these things.
Yeah, we went over the reserves.
It only goes like that.
Alright, doesn't matter, you guys have it in here. So,
On the pipeline, it says nearly all agency condo loans require full worker as of August 3rd. I thought it was all,
a lot of them are already been reviewed.
okay.
So, what happens with Fannie and Freddie? Every time someone tries to add a new one on there, or it's not been approved, it automatically gets reviewed and the entire database gets updated. So, if someone else had bought in there, they might have already done the complete review. So it's not one by one, everyone has to do it. It's if anyone's bought in there lately. So it's a national database and gets updated every day. Go to the next.
How often do they have to do a research study?
The reserve study, it's a new complex that they're trying to do, then they're doing the reserve study there. If it's already been approved, they're not doing the reserve study. So it's not they're gonna do it every time, but what is gonna happen is, coming into the next 4 months, they're gonna have to do the reserve studies pretty much on all of them, because if you don't have 15%, they're gonna say, you gotta up it. And guess how many have 15% right now? And I don't have the exact statistics, but I'm gonna give you a wild guess.
20%?
0. Why? Because otherwise, their HOAs would be, fees would be higher than they are, need to be, and no one wants higher HOA fees.
No, they're awful, right?
So, I'm gonna say that, the reserve study is gonna go through all those things we talked about. Go to red flags.
It says in here, reserve studies completed within the last 36 months, so if it's over 36 months, I can request one from them,
It's gonna be automatic coming up.
automatic.
It's going to be because everyone has to have, or they're matching the 15% on there. Which, like I said, I don't think many are matching the 15%.
So if they don't currently have 15%, everyone is gonna get a review. But once they show they have 15%, every 3 years, they need to show it again. So as long as it's been done in the last 3 years,
Okay,
So, when you go to red flags on there, this is really, we covered it most of the time. Hey, reserve allocation below, it's gonna have to be up. So, if you got an HOA back, and let's say their budget was only 8%, but it was already approved, now how much do they have to raise their reserves? Now it's not 5, they have to reserve 7%. Now, how are they gonna raise that money? One-time assessment probably, and then your HOA fees going up. Also, special assessments that are already out there that might not have been covered yet. Property we talked about, water intrusion, building safety concerns, or structural deficiencies. On newer projects, probably not a big deal there. On the older projects, which are probably the more affordable ones, they might have some issues on there. So, you've done a lot of condos, have you seen some in not great conditions with their common areas and stuff? No?
Well, the one that I'm on right now, one of the things that had to be done was the roof, so they're working on it, they're doing it, they're actually doing it now, so that's what I'm saying, but these guys are ready to go.
And that's not a cheap thing for a condo, all new roof. And then the other thing is the insurances that we had talked about. So, you guys, what I would tell you, there's questions for you to ask up front. Part of it is, do we know what the budget reserve is right now? 2, are they doing a current reserve study? Most people probably won't be able to answer that question, so. Are any special assessments being planned, or are they already there? Is there any active litigation? That's something I would ask every single time. Is there an active litigation? And probably most will not know, is there structural problems in the condo complex right now? Probably no, most people aren't gonna be able to know that, but if you look around and say, hey man, this one is not the best condition all the way
sometimes
around.
it shows up on monsoon, doesn't it? Active litigation or pending litigation? I've seen it show up on some sort of public database, but you can also check current cases with the county. A red flag is if the condo or HOA company is the defendant, that means someone's pursuing a case against them. So you definitely want to look into that more closely. If they're the plaintiff, that means they're pursuing a case against someone. It usually happens in like foreclosures or someone's behind on their HOA payments. It doesn't mean that that's okay, but it's not as much of a red flag. But when they're the defendant, it's worth looking. And one thing you can do is like, let your buyer know that condos require more of a review. If you see active litigation, tell them this could potentially raise issues. So kind of like let them know.
These questions asked up front, is this for the HOA or for the seller?
Both.
Both, right?
I mean, the seller
Cause he's
The
only
seller
gonna
should-
know so much.
The seller should know, but yeah, they can only know so much, yeah.
Okay, so both.
And if you have a listing for a condo, the more of this information that you can gather and let them know like, hey, we already vetted this, you know, like this is okay with this kind of loan, it's gonna help you so much because a condo review can cost like $250 to $400 for a buyer. And then if it comes back that it's not approvable, they just lost their inspection. Some companies will charge them for the condo review upfront, some won't, so we personally don't, but it does cost us, as well.
Not something we wanna do over and over for free.
Right. So the more of this information that you can find out if you do have a listing, the more strong the listing will be based on all these new rules.
So, one of my pet peeves is, you look at a listing and it says FHA, VA, conventional approved. How much research is done into that all the time? Very little, right?
I do, I research. 'Cause I don't wanna-
You're one of the good ones if you're doing the research on it, cause half the time I'm like going, no, this
No,
is it,
because I've been on the buyer's side, and it's like,
got burned.
yeah, exactly.
So it is something, we wanna be a resource for it. Please call these guys or myself when you have it. If you're a listing you're gonna think about doing, let us try to do some research for you to make sure it is what they say it's going to be. And if you have a buyer, let's do a little bit of extra homework up front to make sure that that is FHA approved or VA approved or what have you. So they're all different on how they get approved too. So we'd like to do that for you guys.
And we can help you too, like when you have a listing, we can run it through the loan programs as well to see if it's approved. So you can have that stamp, on your listing.
So gonna go one other area and then we're done if you wanna be done or ask as many questions. Are there have you guys ever done asset-based loans? So, can't prove their income, but we have lots of assets. So there's a couple of loans that you can do that are really good programs. Freddie Mac actually, if someone's of retirement age, do you know the current?
We just changed it, right?
Well, yeah, but it's 240 months. They take all their assets and divide by 240 months. That will give you an income. That doesn't work that much, just to be honest, unless someone who's really has a lot of savings. We have other programs called asset utilization and asset depletion. Both those, they don't really have to do anything. Let's say they have a Charles Schwab account that has an IRA or 401k that they have $1 million in, they have some money here, they have some money there. All right now is they have Social Security and a pension and it doesn't cover what they need to do. Asset utilization programs, it looks at it, depends on what kind of account, it's either 100% they get, so if it's a money market account, they had 200,000, that's 200,000. If it's an IRA and it's not been taxed, a lot of times it's at 80% or 70%. But we just take that formula, divide it by 60, and that gives us a monthly income. 60 is a lot better number than 240. So we use that quite a bit of times to someone who's asset rich, but monthly cash flow poor. And those interest rates generally are really competitive too with Fannie and Freddie.
Can you mix both?
You can?
You can.
Yep. So that would be under asset
Utilization.
depletion, I think.
Utilization's 84. You can use it with both, yeah.
No, just change to 60.
Okay. Oh, it changes. Okay, that's right.
Yeah,
That's
they
right.
both change to 60, which is a much more generous, at 60 months, just make it easy. Someone do the calculator, what's $1 million divided by 60? On there, and it will give you a pretty good monthly income.
Is that for purchases?
16,000 a month,
600.
yeah,
For purchases or?
purchases or refis.
Yeah.
Is that, just say IRA or,
401k, IRAs, brokerage accounts, CDs, everything. Any asset you have can qualify.
If there's an example, there's a couple getting divorced,
Mhm.
and so the guy, he didn't want to refinance. So it should be a good option to get the income from the 401k, and
Right.
then just give the other person the.
Yes, so, it's a great program, it's not gonna be used for everyone, cause you have to have a decent amount of asset base.
Yeah.
But who has that asset base? Divorcees,
Correct.
in that case, people getting ready to retire, that has made some decent money on there. It might be before Social Security taking it, so they don't have that cash coming in, but they have enough money to live on. So it's kind of set up for those types of things. And those are some really good programs.
Did you
out
say equity on the property too, or?
there. No, it's not equity on it.
Yeah, there's different ways for sure.
But if someone has good credit generally, they have assets or they have income, there's almost, we almost always have a way to find them one. And if we
Yeah.
don't, like I said, both these guys are excellent. I've seen Monica. Hey, she works with a person a whole year. Andres has done that same thing too. And you have to have patience to work for a person for a year, month in, month out, tell them what they need to do on their credit, helping them fix their credit, having them show them on income. And then all of a sudden they're ready, we go back to the agent and say, hey, guess what, you referred us this last year, they're ready to go. Those are nice surprises.
Yeah.
So.
Piggybacking on that, so as you guys can tell,